conference on impact evaluation. As Professor Russell showed that this the very interesting intervention in Papua New Guinea, try to improve the financial literacy. Then they try to look at the relationship between the financial literacy and their financial behavior. So this paper is a co-work with Jong-woo Jung, who is a PhD candidate in the Department of Economics at Seoul National University, and myself. So we're also looking at the relationship between financial literacy and their financial investment behaviors in South Korean setting. So financial decision-making is very important to effectively manage household wealth. So nowadays, the very complex financial products have been spreading widely, and also we have a great access to the global financial market. So these financial products may be difficult for financially unsophisticated people to understand. Financial knowledge is a good measure to predict the effectiveness of an individual's financial behaviors. So here, the financially literate people are known to make better decisions. And it is regarded that financial knowledge protect consumer against suboptimal choices, including financial mistakes, fraud, and unnecessary expenses. Recently, we are now experiencing financial shock due to the COVID-19 pandemic. In the South Korean stock market, it was a V-shaped recovery, but still there are still risks and uncertainties around the market. And the comparable previous cases could be 2008 financial crisis. So here, our research question in terms of the relationship between financial literacy and the investment behavior is that whether the impact of financial knowledge, financial literacy on the investment, the behavior is robust between the normal time and the financial crisis time. So here are the financial literate people more stable during the crisis? Do the financially illiterate people cause panic selling during the crisis? Does the effectiveness of financial knowledge still work during the crisis? Those are our research hypotheses. So we try to examine the impact of financial knowledge on mutual fund investment behavior in South Korea. And Korean mutual fund market experienced boom and bust during the 2008 financial crisis. So if you look at this figure, you see that the Korean mutual fund market had grown at an astonishing rate in 2000 compared to 1990. 1990, the mutual fund market was not that big in South Korea, but from 2000, it was a huge increase in pattern. So if you're looking at the here, around 2007 and 2008, right before the financial crisis, you see that the mutual fund market set a record high of $334 billion in September 2008, right before the financial crisis happened. While at the time, investors maintained very optimistic outlook for the growth of the global market and mutual fund market. So here, around 2007 and in the middle of 2008, the individual investors accounts for almost 60% of the net value in the mutual fund market. And then we know that in September 2008, the financial crisis began, and the Kospi stock price index had fallen by more than 50%. And the value of financial products and rate of return plummeted. So at the time, my personal experience is that at the time I also invested heavily in stock market in 2007 and 2008. Unfortunately, two-thirds of my investment portfolios were belonging to the financial sector. So at the time, I experienced more than 70 to 80 minus 80% the loss of my investment. So that was a big shock, not only myself, but everybody in South Korea. So here, but in South Korea, the problem is that most of Korean people, including myself, did not receive enough financial education. So no curriculum requirements for financial education, and many investments are financially not that sophisticated. And what's worse is that some of them, the problem is that there are some people who think that financial market well. So even though they objectively, their financial literacy is low, but they think that they know better. So we also try to looking at this kind of knowledge miscalibration. So just let me briefly go over the literature. So here, in the literature, they suggest two measures of financial knowledge. One is the objective, what they know, and subjective knowledge also got attention from the literature, what they think they know. And objective financial knowledge is known to directly affect the financial behaviors. So people with higher objective financial knowledge are more likely to participate in the market and reduce the searching cost and report more savings. And recently, researchers in this literature have suggested that subjective financial knowledge can manage the relationship between objective knowledge and the behaviors. And subjective financial knowledge is known to mediate between objective financial knowledge and the investment behaviors. So in this Korean setting, right before and after the financial crisis, we're going to looking at the impact of financial literacy on the investment behavior in general, but also specifically, we're going to look at the difference between objective knowledge and subjective knowledge. So just let me, so when it comes to objective and subjective knowledge, we can think of a concept, knowledge miscalibration. So here, if your objective knowledge is high and your subjective confidence, subjective knowledge is also high, then we call this is highly calibrated group. And if your objective and subjective knowledge is also low and low, that's a low calibrate group. But there is like a miscalibration group. The first one is that he thinks that he knows better, high subjective knowledge, but actually his objective financial literacy is low. We call this group overconfidence. And the other group, high objective knowledge and low subjective knowledge, is an underconfidence group. So we're going to look at this interesting pattern, these miscalibrated groups on this financial investment behavior. Just let me skip this one. So just let me repeat our research question. So whether changes in the mutual fund knowledge significantly affect the investment decision during the financial crisis? That's our first research question. And here, the second question is that these relationships between the financial literacy and the investment behaviors are consistent during the financial crisis and after the crisis. Finally, whether the changes in investment behavior can be explained by knowledge calibration concept. So just let me explain our data. So we construct a data set from the mutual fund investment survey. There is a foundation, the Korea Financial Investor Protection Foundation, and they annually conducted a survey for almost 3,000 people annually. It's a repeated cross-section survey, by the way. So this foundation started this survey since 2007. So we received the survey in 2007 and had a small research with Professor Son, who is the discussant in the next session. And at the time, my co-author Jong-woo was our research assistant. But he did an excellent job, so now we are working together as a co-author. But here, this survey got household income, expenditures, and their asset portfolios, so it's a very rich data set. But we are very lucky to have an excellent research assistant. So when we received the data from the foundation in 2007, after that, we continue to get the data from 2008, 2009, and so on. And our co-author Jong-woo found out that in the first 2 years, 2007 and 2008, there are some overlaps. So out of 2,500 each sample size, there are almost 950 respondents are the same. They repeatedly answer in 2007 and 2008. So we were able to construct this 2-year data set as a panel data set. We didn't expect that when we started this research. And after 2009, then we got 8-year data. And it's a repeated cross-section, but what we did is that we created the pseudo-panel data set. So here, each year, there is a 2,500 people. So we just creating the pseudo panel by their gender and age groups and education level and the regions. So that the number of cohort in our pseudo panel analysis is about like 2,000, and each cohort contains about like a 9.1 individual. So here, in this survey question, we measure the financial literacy in this question. So there are 10 questions to measure objective financial knowledge. And the next one, the second set try to measure the subjective knowledge. So if you're looking at the table one, your answer is this statement is true or false or I don't know. So we can measure their objective financial knowledge. But the second set here, we just said, do you know redemption fee? Do you know mutual fund, the commissions and expenses? And then the answer is, I have no idea, or I generally understand and I fully understand. So we just consider this answer as a subjective financial literacy. And our empirical strategy is quite straightforward. So the first 2 years, 2007 and 2008, we are using the individual fixed effect estimation. And here and for when we looking at our third hypothesis, the knowledge miscalibration, and here you see that the first term, the objective financial knowledge, and subjective financial knowledge change, and we control the wealth and the individual characteristics, and as well as we including the fixed effect and time fixed effect, and the error term. Okay. And for the knowledge miscalibration concept, here we just using the pooled ORS model instead of the panel model. So just let me briefly go over the descriptive statistics here. So in our sample of like 22,000 respondents, the average age was 42 years, and this is like range from 20 to 64. So they didn't survey over 65, and also exactly half and half, male and female. And here you see that the objective fund knowledge, like the full mark is 100%, and usually the correction rate is 61%. And the subjective mutual fund knowledge is like 28%. And their assets and monthly incomes, and we also show whether they got an experience in financial counseling and whether they have an experience in investment education. And you see that here, in general, it was a very low experience in investment educations or counseling. Only like 18% or only 11% of them say that they got they got this kind of education. And in panel B and C, is a very interesting comparison between just during the 2007 and 2008. So here, in 2007, before we experienced the financial crisis, here you see that in general, people on average, they have like a 3.2 mutual fund, and 86% of them say that I'm pretty much satisfied with my fund investment. And 37% said that I'm going to invest more. But in 2008, right after they experienced the financial crisis, and you see that the satisfaction rate dropped to 27%, and also I'm trying to invest more is like from 37% to 25%. So you see clear difference between the year 2007 and 2008. So this is our first analysis. So here, our main regressor is your objective financial literacy and the subjective financial literacy. And then, very interestingly, during the financial crisis, only the financial literacy explain the market entry in but after the crisis, from 2009 to 2016, both the subjective and objective financial literacy can explain this market entry. So it's quite interesting pattern that why during the crisis, the subjective, the financial literacy can explain this market entry. So this is the first interesting finding. And so this is kind of extensive market, whether you participate in the market, whether you stay in the market, right? And the next set of the results, we examine the intensive market, so that here, like the number of mutual funds or the value or your investment ratio to your total financial asset, or whether you got a gain from your investment, mutual fund investment. And again, when we're looking at these intense margin outcomes, still objective financial literacy doesn't have any explanatory power, but subjective financial literacy have a strong explanatory power to explain this intense margin outcome. Okay, and then, but the clear different pattern is that after the financial crisis, so when we're looking at the sample from 2009 to 2016, now objective and subjective, both this financial literacy now can explain the association between their literacy level and their investment behaviors. So this is a quite interesting pattern. So then here, during the financial crisis, those who have a high subjective knowledge are more likely to stay in the market, more likely to enter the market, and also more likely to expand their investment within their portfolio choice. So then, who are they? Maybe are they like the knowledge calibrate people, so high subjective financial literacy at the same time high objective knowledge, or are they just simply overconfidence group? So that's our next question. So this result based on pooled ORS, so still it's the all correlation, but this correlation analysis show very interesting pattern. So if we divide the four group, so low calibrate group, that is our reference group, so that the low financial, the objective and subjective knowledge, and the overconfidence is that low objective knowledge but high subjective knowledge. And then here during the crisis, those who more likely to enter the market is not overconfidence group but highly calibrated group. And however, if you look in the post-crisis section column 3 and 4, and now compared to the low calibrated group, both overconfidence or underconfidence or high calibrate groups are more likely to participate in the market, right? So from the result 3, we can have like suggestive evidence that during the crisis, this high calibrated group are more likely to participate in the market, stay in the market, less likely to do the panic selling. And also looking at the intensive margin outcomes, again, the same thing. This overconfidence group during the financial crisis, they are not related to the intensive margin outcome like number of mutual funds or value or asset ratios or gain. But the highly calibrated group, high objective and high subjective knowledge group, they are more likely to have the more mutual funds and their values are more higher, and they are more likely to, but here the gains in the time is not significant, but the patterns are very consistent. And the same thing after the post-crisis, here these three groups compared to our reference group are more likely to get the higher intensive margin outcome. So our conclusion is that we examine the impact of both objective and subjective financial knowledge in different macroeconomic situations. And we find that subjective fund knowledge plays an important role when people experience macroeconomic shock like financial crisis. And individuals with high levels of subjective knowledge are more likely to stay in the mutual fund market and invest more in this market. But our suggestive evidence say that the impact of subjective knowledge during the financial crisis is not driven by overconfidence group, but highly calibrated group. So this suggests that a certain level of objective financial literacy, financial knowledge is still very important during the financial crisis. So our future research should pay more attention on this subjective knowledge and objective knowledge's relationship. Thank you for your attention. Thank you.